I'm here to help you guys think through, and let you guys know what to be aware of as a self-employed person from a tax perspective, and how you guys can not put yourself in a position where you're all of a sudden hit at the end of the year with an unexpected tax bill, which happens a lot of times with people who are, self-employed their first year. So for people who are, and if you guys have heard me before, I apologize. It's probably something, you're going to hear the same thing again. But hopefully, this will be beneficial for at least some of you in here. So for people who are self-employed, and I'm just going to write up here, people who are self-employed can be classified in a number of different ways. There's either a sole proprietor, okay, an LLC, a partnership, an S corp, or a C corp. Okay. Those are the 5 different ways that businesses can be established. Now, somebody who's a sole proprietor is just somebody who just starts doing business. They don't do anything to formally organize themselves. They're considered a sole proprietor at that point. An LLC is a limited liability company. It is not a corporation. It is a company. A partnership is a limited liability company that has more than one owner. And these 3, from a tax perspective, are handled very similarly, which I'll talk about here in a second. You have an S corporation and then a C corporation. I'm not going to really talk about C corps very much, just because they're big corporations like McDonald's or something, which highly unlikely that anybody in this room is going to reach that point. For now, I do want to focus on these 4 here. And from these 3, these 2 are handled exactly the same way, in that they go, your taxes are all handled on your personal tax return. You don't have to do any extra tax returns or anything like that. This one, you do have to do a separate tax return on it, but it does go again on your personal return. All 3 of these, whatever you show as profit, which I'm going to use pi to, we'll talk about profit. So whatever you show as profit is all going to be subject to what's called self-employment tax. Anybody ever heard of self-employment tax before? Okay, self-employment tax is for people who are self-employed, and it's the way that they pay into Social Security and Medicare. If you guys all been at a job where you've been paid on a W-2 before? Mm-hmm. Everybody's been in that position, all right? So on a W-2, you have 3 taxes withheld, right? You have your federal withholdings, you have your Social Security, and you have your Medicare, right? Mm-hmm. Everybody knows that? Mm-hmm. Okay. Federal withholdings, that's what, when you fill out that W-4 form, it says 1 if you're single, 1 for each kid that you have or whatever. That's what determines what your federal withholdings are. And your federal withholdings are basically you paying ahead of time towards whatever taxes that you're going to owe at the end of the year. And when you get a refund back at the end of the year, it usually is because you paid too much in federal withholdings, right? Social Security and Medicare, the way that works when you're paid on a W-2, you have the employer who pays half of it for you, and then you as the employee have the other half withheld out of your paycheck, right? So every paycheck you see Social Security and Medicare with deductions. That's the half that's coming out from your portion. What you don't see on your paycheck is the half that the employer is paying on your behalf, okay? This is 7.65% that the employer pays on your behalf, and 7.65% that you have withheld out of your paycheck, every paycheck. Okay? When you add these 2 together, you get 15.3%. 15.3% is the self-employment tax rate. Okay? So people who are self-employed basically have to pay both sides of it, whereas if you're on a W-2, the employer pays half of it for you. Okay? So most people just in hearing this think, well, then it's better obviously to be paid on a W-2, right? Not necessarily. The reason why I say that is because you're paying 7.65% in Social Security and Medicare on 100% of your income, okay? Whereas the self-employment tax is only applicable to whatever you show as profit, okay? So you're paying the full 15.3%, but you might only be paying that on 30% of your income if you're only showing 30% profit, right? So it all depends on how much profit you show as far as which one is more beneficial. In a lot of cases, it's actually more beneficial to be self-employed from that standpoint. The difficult part is that you have to fork out all that money usually at the end of the year, whereas most people pay it every paycheck and they don't even think about it. Okay? All right, so that's the self-employment tax. Now, what I want to talk about today is there's actually a way that you can set yourself up to where not all of your profit is going to be subject to your self-employment tax, only the portion that you decide you want to have subject to that. Okay? And that's by doing the S Corp route. Okay, so the difference in becoming an S Corp is that as an S Corp, one of the requirements of being an S Corp is that you, as the owner, have to pay yourself on a W-2, what the IRS calls a reasonable wage. Okay? So basically, in this scenario, you would be paying yourself on a W-2, and you would be both the employer and the employee. Okay? So you're paying both sides of the Social Security and Medicare, the 15.3%, which is the self-employment tax, but only on the amount that you determine you want to pay yourself on a W-2. All right? So let's say, I'm going to break it down to numbers because it makes it a little bit more clear. Let's say you're in a situation that after everything, you end up profiting at the end of the year. Your total profit equals $30,000. Okay? If your profit is $30,000, in this scenario, typically if I see somebody like this, I recommend that they pay themselves about $12,000 on a W-2. Okay? So you have $12,000 that goes on a W-2. Your other $18,000, okay, because you're still showing $30,000 of total income. $12,000 of it goes on a W-2. $18,000 goes on what's called a K-1, which also goes on your personal return. And that K-1 is not subject to self-employment tax. Okay? So basically, if you were in this scenario and you're profiting $30,000, you would be paying roughly $4,500 in self-employment tax. That's 15% of 30,000 is 4,500. Okay? In this scenario, you would only be paying about $1,800 in self-employment tax. Does that make sense? Okay, so basically, just by doing this process alone, you're saving yourself about $2,700 in taxes. Okay, so it can be very, very beneficial. The more profit you show, the more beneficial this becomes for you because you save more and more money that way. I know somebody who literally shows $1 million in profit every year, and they pay themselves $25,000 a year on a W-2. So he saves quite a bit of money just by doing this. So I don't necessarily recommend you be that aggressive, although he's been doing it for over 20 years and never had an issue. So.
Is it true that when you apply for like a loan or a mortgage or things like that, they would look at that you only make $12,000 though, not 30?
No, they look at your total income. You're still showing 30 because they're going to consider the K-1 as it's profits from a company, and that's still considered income. Yeah. I just went through that process last year buying a home. Yeah. So sometimes what they're going to want to see if you do go through the process of buying a home, they're going to want to see 2 years worth of records. So if, let's say you've only done this for 1 year, what you can do most of the time is give them what's called a profit and loss statement to cover your second year. But yeah, they will consider both your W-2 income and your K-1.
And what happens if you do this like halfway through the year?
Okay, so good question. So it depends on who you're being paid from. Most of the time, you can get away with, like if you're halfway through the year, you can get away with them. Once you set up the S Corp, you get yourself an EIN number. A lot of times you can get them to pay you the full amount of your income because all of that's reported at the end of the year. You know, they give you your 1099 or whatever at the end of the year, so you can get away with them reporting that to your EIN number. Now,
I was told you have to wait till the next year.
It depends.
Okay.
It depends on, like, if you forget to make the election, they can say you have to wait till the next year. But let's say that you're in a position where right now you just set up an LLC, right? Once you set up, okay, let me back up a second because I didn't go over that. So what I usually recommend that people do is set themselves up as an LLC because you still get the advantages of being an LLC. However, you can do what's called an election to be taxed as an S Corp. So you can basically get the best of both worlds by doing that. As an LLC, there are some legal advantages, and I'm not going to really go in depth on those because I'm not an attorney. Not necessarily, I don't want to give you any, erroneous advice along those lines. But I know that there are some legal advantages to being an LLC. So usually when I have somebody who comes in who's self-employed, the first step I do is have them set up an LLC. Now, once you've established an LLC, to make the election to be taxed as an S Corp, they give you 45 days. If you're outside of that 45 days, that's when they can tell you you've got to wait until the next year. However, you can always apply for what's called a late election, and they can make it valid for that current year as well. So, but good question.
So you're basically saying though, like, so if somebody did it in July, you're
Mhm.
saying that I could adjust so that it shows, like, it goes back kind of retroactive to January, is that what you're saying?
You could. Now, there's also a couple of other things to keep in mind. So for example, let me give you an example of a realtor, because this is a very easy example that'll, I think, answer the question you have. So as realtors, they have to be paid to their social security number. Even if they have a company with an EIN number, their commissions have to be paid to their social security number. So in that case, what will happen is, they would show their income on their personal return, which goes on what's called a Schedule C. Okay, which their Schedule C would be very simple on their personal tax return, because what we would do in that scenario, we'd show the income on the Schedule C, and then we would have one line item as an expense that says income to and the EIN number of the company that they'd set up. So basically, the Schedule C becomes like a pass-through, and the income goes into the Schedule C where it's supposed to go, but then there's a one line item that goes as an expense that passes that income over to the company. Right, so even if you're in a situation where you have, let's say you do it halfway through the year, they give you two different 1099s, one to your social and one to the EIN number, you can do a pass-through on that. But good question. But obviously, like I was saying, the advantages of this become greater and greater the more profitable you become. Now, there are some, I wouldn't say disadvantages, just some more hurdles that you have to go through in order to be an S corp. Now, again, you've got to pay yourself on a W-2. What that means is that you have more filing requirements. You have to file on a quarterly basis as an S corp. So you have to file what's called a federal Form 941 and a state Form RT6 every quarter. So every quarter you have to file both of those two forms. Then at the end of the year, you have to file a W-2 and a W-3 for yourself. You can file 1099s if you have people that you have work for you or anything like that. But you are required to do 941 and RT6 every quarter. You have to do at the end of the year Form 940. Again, you have to do your W-2 and W-3, and then at the end of beginning of the following year, you have to do what's called an 1120S, which is your S corp return, and then you do your personal return as well, your 1040. So there are a lot more filing requirements that go along with being an S corp. Usually, what I tell people is once you hit about 20,000 in profit is when it becomes beneficial for them to do the S corp route. And the reason why I say that is because I tell people who are coming to me that, and the reason why is because usually the extra cost for doing all the extra filings is right around $1,200. That's where it kind of starts out at for somebody who's starting out. And somebody who's in this position probably is going to be in that position. So once you hit about 20,000 in profit, then this begins to pay for itself because of the tax savings that you're going to experience.
And is that's for someone else to file those for you? Like, if someone came to you to file that, it would cost them about $1,200.
Yeah,
to do all those yourself.
Right. So to break that down for you, and that's typically how we break it down, and that's going to be probably on the less expensive side of anybody that you're going to find out there. Mainly a big portion of that is going to be the 1120S return. That return, if you go anywhere to get it done, you're going to look at a minimum of 400. Usually it's between 600 and they could even be up to, I mean, I've seen them for several thousand from CPAs and stuff. So those get pretty expensive pretty quickly. So just that alone is 400. What we do for our clients is we typically, like I said, 1,200 is kind of the starting point. For us, we found that it's easier to kind of, for us and for our clients, to break that down into a monthly expense. So we just tell them $100 a month. That will cover, all of your. We'll do all your bookkeeping. So what we do is we have them set up an accountant's login. They give us that information for their online banking, where all we can do is go in and see information. We can't transfer money or anything like that. Then what we do is we go in on a bi-weekly basis, pull transactions, allocate them. So if you're in a position where you need a profit and loss statement at any point, you can always say, hey, I need a P&L, we'll pull it for you, and And it's that simple because we're already keeping track of everything. So we do all of that. We do all the quarterly filings. We do the annual filings, and we lump it all together at $100 a month because we find it's easier for people to budget for that. Now, that doesn't mean that they can't just pay us at the end of the year. I'm just saying for a lot of people, it's easier to budget accordingly if they know it's coming out on a monthly basis.
I just have like a kind of a question that's outside. So if you make a purchase
Yep.
that is a monthly purchase, say for instance you buy a car. Now
Yep.
we all use our cars for, you
Sure.
know, to travel.
Mhm.
How does it work for like your write-off purposes?
Mhm.
Like if I buy a car before the end of the year,
Yeah.
then I know like you know you pay monthly. So is it only the monthly portion that you pay is subject to the
It
write-off?
depends. That's a good question. It depends on how you're set up as a business. If you're set up as a sole proprietor in an LLC or a partnership, well, partnership's a little bit different, but sole proprietor in an LLC, basically you wouldn't really be able to write much of that off. All you would be able to do is mileage, which mileage is a significant deduction, right? As an S corp, you can get the vehicle under the business's name, and you can write off your payments. You can depreciate the vehicle depending on how, you know, if it's a vehicle you buy solely for this purpose, you can depreciate that. There's different ways that you can handle it as an S corp that you can't do as a sole proprietor or an LLC.
Can you explain, are there any other benefits as far as an S corp versus an LLC for just what you can write off? Like as far as like your home office, a bunch of us, obviously we work,
Right.
you know. we're drawing off of-
There are.
Are they,
I will say this though, that from a write-off standpoint, until you get to the point where you become a larger company, that the write-offs aren't going to be much different,
Okay.
whether you're an LLC or an S corp. There may be some minor differences in the two, but your write-offs are going to be pretty similar until you get to the point where you're, you know, profiting. You know, you're looking at when you're bringing in revenue over 250 grand a year, then you definitely can experience a lot more write-offs as an S corp.
How does this work when you're filing like, together with your spouse who's a normal W-2?
Mhm.
If,
So-
let's say I was
Yep.
an LLC, billing as an S corp,
Yep.
and he's just a regular W-2, how does that work together?
Okay, good question. So basically what happens is at the end of the year, your company does an 1120S return. That 1120S return is going to produce a K1 for you as an individual. So that K1 is just going to be the remaining profits from the company. So you're going to have both, the W-2 and the K1, which will go on your personal return, which is your 1040, and it's going to be added to your spouse's income. Make sense?
No.
No.
That's a lot of numbers.
This is not
So
my
when you're
field,
doing-
guys.
When you're doing mileage and all of that kind of stuff, is that done after they're combined?
No. So all of that is going to be done. So everything that pertains to the business, if you're set up as an S corp, is going to be done on this 1120S.
What if you're a sole proprietor?
Okay, if you're a sole proprietor, then all of that is going to go on your personal return under a Schedule C. So that'll go on your personal return.
Okay.
Yep. So basically, in this case, you're doing a separate return where you're handling, on the separate return, you're reporting all of the income for the business, every expense, you're doing everything there, and then at the end, once you're done with all your expenses, whatever's left over as profit goes on this form of K1. And then all that becomes is like it's just a tax form that is reported on a different line on your personal return. Yeah. Whereas the Schedule C, in essence, it's very similar because the Schedule C is a separate form. It's just a separate form that's attached to your personal return. It's not a separate return. Does that make sense? You're doing the same thing on a Schedule C, just on a smaller scale than what you would be doing on the
So, I'm just kind of paraphrasing here. So it sounds like if, you know, you're really pulling in the books, then the S corp is the way to go. If you're not, then the LLC might be a better
Yeah,
bet,
so
or-
again, the S corp has, the reason why the S corp wouldn't be a better option for you if you're not bringing in as much money is because there's the extra filing requirements, right?
Gotcha, okay.
So you're just, if you're not really, you know, bringing in a lot of money, the extra filing requirements are just kind of doing that for not really,
For no reason.
you're not getting to experience much of the benefit of being an S corp, right? So the benefit of being an S corp is the fact that you can shelter a lot of your income from being subject to that self-employment tax.